You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, speaking today with Joe Mazumdar, analyst from ExplorationInsights.com. Joe, welcome back onto the show. It's been a few months. Let's talk mining reform in Mexico. The lawmakers there just implemented a little tougher, harsher mining laws, not as friendly to the companies. Can you break down the key aspects of this and how it is affecting your personal investing in Mexico, please?
Hey, Bill, thank you. The actual reforms, a lot of companies were expecting them in September. This was something that was coming up. I talked to a company about the first draft of the reforms, and they were hoping that the next draft would be less egregious. And technically it was, but it's still a bit of a shock for some companies that didn't see it coming. And it happened over the weekend, where the Morena party that Andrés Manuel López Obrador, or AMLO, runs, they have the majority, but they actually took this off-site and voted on it, and then it sort of became released. And so what I was seeing was a bunch of interpretations from different lawyers about what it meant. And what I can gather is that any company with concessions right now seems to be grandfathered. So whatever rules and regulations were implemented for their concessions stays the same. And so companies that are, operate there, that are from there, like Grupo, they're okay with it. The big objection originally was the mining term. The term of the concessions was like 50 years originally. Then there were rumors that it would be 15 years and then a renewal of 15 years. So 50 going to 30. But what's come out now is 30 years and then a 25-year renewal. And the renewal isn't automatic. It's conditional upon, a lot of impacts. And so, but then we get to all those people, like, as we know, that there, being a sort of pseudo moratorium on applications for concessions, during AMLO's period. And so what they've been waiting for is the new mining law reforms to be able to implement on the new concessions. And so now they've put them in. They're saying that anybody that had a pending concession is not grandfathered. They're basically canceled. And so they have to start again. And now the new concessions require a lot more reporting. They require a lot more studies. And some lawyers have interpreted that to mean that social impact, ecological impact, bonding, a lot of these other things that you would do for, putting forward a mine are required at the exploration stage, which is hard for a junior explorer. Mexico gets a lot of exploration funding. Being next to Chile, outside of the U.S. and Canada in the Americas, it's like fourth. And a third of that money comes from juniors. And so the question is, like, if you're a junior explorer, given, the high barrier to entry right now to actually get a concession, do you choose Mexico anymore versus another spot? Mexico is the number one silver producer in the world. It's top 10 in copper and gold. And so will people look other ways, into other countries? Who's ever there right now, I think they're fine. But the problem is, even if you want to acquire concessions, the transfer of concessions is conditional now. It's not automatic. And so that's another problem. I'm going to a seminar tomorrow to get a little bit more, but it seems to me that a lot of these reforms that have been put out are being interpreted and are going to be contested, and some of them are going to test the constitutionality of them as well.
So if there is an Explorco or developer in Mexico right now, and they have geological success, prove out a deposit, does that deposit, is it going to be valued less by the market, do you think, according to your current understanding of what they've changed here?
Well, if the market understands, and if it is true that the concessions are grandfathered, the negative sentiment would discount some of these ones that may not be impacted by the mining reforms, because for them, technically, nothing has changed. But the ones that would be impacted are those companies that have pending concessions and have raised money to work on ground and then suddenly find out that they don't have the ground. There was a recent cancellation of concessions held by Chesapeake Gold, 700 hectares of their 4,200 and I think 60 hectares that go on their resource. They're contesting that, and we'll see. And I know Radius Gold had applied for concessions around their Amalia joint venture with Pan American Gold. That where the joint venture area is, that concession was granted, so that's not a problem. But they picked out a much larger land package. Now the federal government is sort of giving them the impression that that's not going to be grandfathered. That could be canceled. But they already had approval by the local state. And the problem is, their problem is that the time allocated for the federal government to actually make a decision on it was passed by the federal government. So they're saying that, okay, you passed that timeline. It's not our problem. It's your problem. And so we're going to take you to court. And so what we may see is a lot of court action. And the biggest winners out of this might be the local legal community in Mexico.
And at the macro level, net result, possibly less silver supply and less copper supply would be a result of this 5-10 years down the road?
Well, I don't know about less copper supply because Grupo seems to think it doesn't impact them and they've got all their concessions, and copper is mostly in the north. Right now, you don't see a lot of juniors looking for copper in Mexico just because most of that ground has been tied up by companies like Grupo. But silver, definitely, for people looking for new silver projects, that they have this nice idea that now this ground has opened up, this area is now available, let's get that, and now we can apply for concessions. The time to get the concession, the amount of work required, it's got to be an incredible sort of deposit. But then the other problem is that you don't have first pick of the project because then it goes up to a Dutch auction where everyone's got a bid on it now. And that's another problem that they've introduced.
Interesting. Well, let's continue to talk governments and mining policy. Let's move down to Chile. Their lithium policy. What are your thoughts on this and how it's impacting the lithium sector?
So Chile, like copper, they're the number one producer, and they're, I think, second or third behind Australia with respect to lithium production. But they have the biggest reserves of lithium. But this is more all brine, Salar de Atacama. The biggest producers are a local company, SQM, and then the other one is Albemarle. SQM already has a lease, I think, until the early 2030s, and then Albemarle has a lease until 2040 something. So they're guaranteed to produce what they produce up to that time, and they're the major producers. So what they want to do is do joint ventures. They'll create a state company that now does joint ventures with companies that have lithium deposits. So no company can actually own a lithium deposit in Chile once this gets implemented, except for those guys with leases, that it will happen after the lease expires. So now it's sort of like if you spend all the money, get the concession, do all the exploration, do the development, then put it into production, you give away 51%. Right now, I don't know what the value, monetarily, what the market value that they pay for the 51%, how that works. But the thing is that, it's hard to convince, shareholders or prospective investors that, hey, we do all this work and then we get a minority stake in it. And then, who's going to take over my minority stake, let's say, like in terms of M&A, if that's my exit strategy. That's another problem because even if you take me over, you will never have operatorship of this
Will
project.
The government pay back the issuer for all that money spent to give away half of the company?
That's the other question. It's like all that money you spent on development, on exploration, does that money come back to you? I don't know. But it obviously, puts them down the rung with respect to if you are looking at, at brines, you're probably going to prefer to go to Northwest Argentina than Chile.
Mm-hmm. Well, Glencore's bidding for Teck Resources. What's your thoughts here, Joe? You like this offer?
Well, the thing was, if we go into background, Teck's obviously a big diversified miner, one of the last ones in Canada. Vale took Inco, Xstrata, then Glencore took over Falconbridge, and so basically this was what is left is Teck. And Canada's putting out this big critical mineral policy and all that, and they won't have a local champion of it who has not only mines, but also refining capacity. And so Glencore is put the bid in prior to Teck spinning out their coal assets. The idea was to spin out the coal assets, for ESG, look for the Teck Resources part, the Teck, which would have the copper, which would be where all the growth was, and then the metallurgical coal assets would sit outside that. But the metallurgical coal was the one that made the most money in 2022. And so Glencore wanted both, and they wanted to do it before the SpinCo. The SpinCo vote never happened because Teck couldn't get enough votes for the SpinCo. And one of the reasons, I believe, was there's a Chinese company that owns a significant block, I think it's 10+%, that prevented them from getting the majority to get the SpinCo to work. So what they've saying is, okay, well, let's change the arrangement on the SpinCo, and then we would be open to an M&A, by whomever. Glencore wants to do it before, because they probably think that once they do the SpinCo, there might be more bidding on the metallurgical coal assets, and it might be, it might become at a higher price than they want to pay for it once it's nestled in Teck. So looking forward, I bought some Teck because I'm interested not only in their copper, their diversification. I'm also interested in the metallurgical coal because there's not a lot of people building new coal assets, and so that spin out interests me as well. It's going to get resolved eventually, but the Canadian government sort of saying, we're not sure if we approve this with respect to foreign investments in Canada. So that's another sort of, problem that's arise. But if you realize Glencore's got, a lot of assets in Canada because they bought Falconbridge, so they've got a lot of assets in Canada. So it doesn't mean it doesn't make sense, but there's still Swiss space. So we're not really sure how this will turn out, but right now the SpinCo is not happening. And Teck is looking still to do that, and Glencore is still in the background on bidding. But I know there's other companies out there that are sitting at the sidelines waiting, hoping that they might be a more appropriate, suitor that the Canadian government might be okay with. So that's all drama that's happening in the background. But this is going to take a little longer to play out.
When it comes to the gold majors, Mark Bristow, head of Barrick, said that he's looking to acquire good projects, but not necessarily companies via what he calls stupid deals. Any comments on Bristow's comments with what's going on in the gold majors?
Well, what we've seen is, with the intermediates is they can see that there's a big discount with developers because retail market doesn't like developers because it's on the other part of the Lassonde curve, and they never know if their money's the last money in. Do they have enough money? And we've seen a lot of big failures in development projects, whether it's Magino, Northern Ontario. We've also seen Pure Gold, that sort of stuff. And so people are scared of development plays. And so they traded at a deep discount. So what we've seen is B2 Gold acquire Sabina. We've seen Gold Fields come in with a 50-50 on the Windfall project with a Cisco. It would have been worse for a Cisco because they would have had to raise that entire $1 billion all by themselves, which would be highly dilutive. Now they have an operating company with a lot of underground mining experience coming in, so that's good for them. And they also inject like $600 million of cash into it for them, to actually use that for their funding of their half. So you can see that, people sitting on significant assets that are sitting there with a financing, problem, that a major that's got access to capital can come in and get it at a discount. And so, that sort of commentary makes sense. But it all depends what you're trying to do. Like Newmont is trying to be the gold play. They want not to just be incrementally above Barrick and then Barrick come on top of them. They want to just make a big move and get, as opposed to jumping across a pond and waiting for Barrick to jump across it, they want to just fly over the ocean and just say, okay, now catch me. So then any investor in gold will look at that and now look at Newmont versus the ETFs, which is their ultimate competition, and just go, well, the ETF is nice, but Newmont offers me liquidity like the ETF, offers me diversification, assets, geographic diversification, but also gives me a dividend, whereas the ETF doesn't give me a dividend. And the main thing that is important for a dividend is cash flow, so consistent cash flow. And so the way to do that is to get bigger, have more assets, and then a little bit more diversification because now they'll get more copper. And another big important thing for Newmont is that they, at my time there, they weren't very good at all in block cave mining. And block cave mining is like an underground open pit. You take lower grade, but you take it almost as an open pit mining cost, but it requires a lot of upfront capital. Newcrest is really good at it. And so these copper gold porphyries that are big, low grade deposits, and then you don't want to have a huge footprint. That's one way of doing it, is with underground block cave. And so that would open up a lot of potential M&A and make some assets within their portfolio more valuable, some of them being the ones that they acquired from Goldcorp in Chile. So I think it makes sense for Newmont to do what they're doing, but I do agree with Bristow in terms of some of the value add for these intermediates and other companies might be in the single asset developers that are up against a big financial, obstacle in front of their face, and they don't have the means of getting over that obstacle.
Do you think the financing window is opening for juniors right now?
So for junior explorers, we've seen, like, as gold's gone over 2,000, market volatility increasing, the bank crisis in the States, people more interested in gold. The thing is that over the last 2 years, what's been driving gold hasn't been gold ETFs. It's been central bank purchases. That's what's been driving it. There's been net withdrawals of ETFs over the last 2 years, 2021, 2022, according to the World Gold Council. And so any movement in gold is a perfect window for some of these companies, and they need to hit this window before the field season opens up in North America. And so I've seen a lot of the companies we have in the portfolio as well try to take advantage of this window, and they have been successful in doing so, but it hasn't been a big flood, let's say, of companies. There'll be more industry, like private placements to help companies. In terms of development, we've seen government come in to help development projects, but mostly for critical minerals. We've seen private equity come in. The streamers are always about trying to help these companies, not help them, but help fund them. So we'll still see that kind of financing. It's just a little bit more tough in the equity markets right now.
When you look at the decarbonized movement and the demand that will create for specific minerals, is there a specific mineral that you're seeing that maybe is being a little bit overlooked by investors right now?
Yeah, there's the thing about these minerals, and we know, the niche markets are hard to invest into because the actual liquidity for that commodity is very low. And so if anything happens on the supply or demand side, like, hey, we build a new mine and that totally kills the supply question and then drives the price down to nothing, that can happen in a small niche market. You have to hope that niche market is no longer niche and is growing. But that growth might not come for 3 to 5 years. And so in the interim, you might have a problem with that niche market. And so my exposure mostly in terms of this carbon neutral electrification world has been in copper because it's a more liquid. But there are other commodities that I've looked at that fall within a company that we have in the portfolio, like rare earths, graphite, as we talked about before the call, that's more on the anode part of the battery rather than the cathode. And we've also talked about, the segmentation or bifurcation of the global supply chains, suggesting that, hey, maybe a low-grade deposit in this supply chain would work because then they can't go to that one. The problem that we've seen is that, all this talk about bifurcation, and I've talked about it as well, is that, when we see the latest statistics about where the U.S. is getting refined fuel, we see that they're getting it from India. And then the question is, where does India get their crude oil? Well, they're getting it from Russia. So all this is coming out and it's going back in the supply chain. And so, for all of our concerns, the problem, whatever, I mean, it's coming. That all those products are making it to the market, regardless.
One thing investors in the resource sector are getting wrong now that you see that they don't realize that they're getting wrong, or what faulty assumption do you see on a wide scale measure that you see resource investors are miscalculating right now?
Well, I think it's basics. I mean, just like, we follow grade a lot, and look at that grade, look at that intersection, and then actually trying to look at that intersection, like from a junior explorer, and just say, okay, what is this? Is it like 1 meter of 100 grams giving me 100-gram meter, or is it 100 meters of 1 gram? So that's two different types of deposits. And then say, is this open pittable? And so if it goes a kilometer and the grade doesn't change, then, after a certain vertical, maybe 500, 400 meters, it's a different cutoff grade. And maybe that mineralization doesn't matter because it's not exploitable, and then also looking at, what is that easy to extract, not only from a mining point of view, but from a metallurgical point of view. So if it is Carlin style and it is refractory, then you'd need an autoclave or a roaster. And then if you're in Nevada or anywhere, where are you going to get that from? You build it, it's high capital, or you're going to sell it to Nevada gold mines, and then that's a toll milling arrangement. And there's not a lot of companies that make money on toll milling. And so it's all that added sort of interpretation that you need over just, hey, that's a nice intersection, I think that we're missing.
Excellent insights. And more of Joe's insights can be found at explorationinsights.com, where Joe is the editor and lead analyst. Joe, really appreciate your insights, and I'll bring you back on the show in about 3 months if you're available.
Right. I should still be around.